Hedge Funds, Definitive Strategies and Techniques, edited by Kenneth S. Phillips and Ronald J. Surz, book summary. Imagine a world where money isn't just earned, it's engineered. A world where the brightest minds in finance don't play by the same rules as everyone else. A world where the line between genius and madness is razor thin. This is the world of hedge funds, where fortunes are made not by luck, not by chance, but by pure strategy. Here, success isn't about following the herd. It's about seeing what others miss, exploiting inefficiencies, playing the game at a higher level. But what really happens behind these closed doors? How do these secretive funds pull in billions while markets rise and fall? And why do they continue to fascinate, mystify, and sometimes terrify even the most experienced investors? Today we dive deep into Hedge Funds, Definitive Strategies and Techniques. A book that doesn't just explain hedge funds, it reveals their playbook. This isn't just about investing, it's about control. Because in the world of hedge funds, there's no second place. There's winning and there's losing. And the difference? It all comes down to the strategy. Scene 1. The Rise of Hedge Funds. The story begins in the 1940s, an era of bold ideas and economic transformation. The world had just emerged from war. Markets were shifting, and a new breed of investor was rising. One who wasn't satisfied with simply following the tide. At the center of this revolution was a man named A.W. Jones, a former journalist with a PhD in sociology. Not exactly your typical Wall Street tycoon, but sometimes it's the outsiders who see what others don't. Jones had a radical idea. What if you could create an investment fund that didn't just ride the waves of the market, but controlled them? Instead of just buying stocks and hoping they go up like everyone else, what if you could bet against stocks too, making money even when markets crash? What if, by balancing these positions and adding leverage, you could amplify gains while reducing risk? This was more than just an investment strategy. It was a game changer. The result? A brand new type of investment vehicle, the hedge fund. Hedge funds weren't just profitable, they became legendary. For the elite, this wasn't just an investment, it was a ticket to an exclusive club. Billionaires, pension funds, institutions, all were drawn to the promise of high returns, secretive strategies, and financial power beyond imagination. But behind the glamour, behind the stories of private jets and billion-dollar bonuses, lies something deeper, a world of brilliant minds, cutting-edge algorithms, and a relentless pursuit of one thing: market inefficiencies. And that's where the real magic happens. Because in the world of hedge funds, knowledge isn't just power, it's money. Scene 2. The hedge fund playbook. Hedge funds don't just buy and hold stocks like your average mutual fund. No, they play by a different set of rules. They operate in the shadows of the financial markets, looking for hidden opportunities, market inefficiencies, and overlooked patterns. It's not about following trends, it's about outsmarting them. The classic hedge fund strategy. This is where it all began. The long-short equity strategy was pioneered by A.W. Jones himself in the 1940s. Here's how it works. Hedge funds buy strong stocks, long positions, companies with solid fundamentals, rising earnings, and future potential. At the same time, they bet against weak stocks, short positions, companies drowning in debt, losing market share, or on the verge of collapse. The genius of this strategy? Market neutrality. If the market crashes, short positions make money. If the market surges, long positions win. The goal isn't just to profit from good stocks, it's to profit from the entire market's movement. But this isn't a game for the reckless. Get it wrong, and losses can be catastrophic. 2. Arbitrage, the art of riskless profit. Ever noticed how gasoline prices vary from city to city? What if you could buy cheap in one place and sell high in another? Instantly, risk-free. That's arbitrage. Hedge funds do this at lightning speed, capitalizing on minuscule differences in stock, bond, and currency prices across different markets. A stock trading at $100 in New York might be $99.50 in London. A hedge fund spots the difference, buys low in London, sells high in New York, and locks in a guaranteed profit before the prices align. Sounds simple? Not anymore. Today's markets are hyper-efficient, and arbitrage has become a battleground for high-frequency traders and supercomputers. The fight for fractions of a penny is an arms race in speed, technology, and capital. The world is a chessboard, and hedge funds play the long game. 3. The global macro strategy bets on world events, economic policies, and market trends. If a hedge fund sees a recession coming, they short stocks and bonds before the economy crashes. If inflation is on the rise, they buy commodities like gold and oil to hedge against a falling dollar. If China devalues its currency, they bet on US companies that will benefit. This is big picture investing, predicting the future and placing bets accordingly. But the stakes? Astronomical. One wrong move, one miscalculation of global trends, and billions can vanish overnight. 4. Managed futures. The Wild West of trading. Think stocks are volatile? Try commodities. Managed futures hedge funds bet on everything from oil and gold to corn, cattle, and currencies. Why does this work? Because markets are driven by supply and demand cycles. If OPEC cuts oil production, prices spike and hedge funds bet long on crude. If a drought ruins the corn harvest, food prices rise and funds buy futures on agriculture. If a country's currency weakens, hedge funds bet on stronger economies. These funds thrive on momentum and trends, riding the wave until it crashes. 5. Distressed securities. The vultures of Wall Street. But for hedge funds, it's an opportunity. Some funds specialize in buying the wreckage of failed companies, stocks and bonds that no one else wants. When Lehman Brothers collapsed, some hedge funds bought its debt for pennies on the dollar and made a fortune when parts of the company recovered. When General Motors went bankrupt, hedge funds bought distressed bonds and profited when the company emerged stronger. Not every company survives, but when they do, the payoffs are massive. These strategies aren't for the faint of heart. They require deep market knowledge, understanding global economies, corporate balance sheets, and political shifts. Sophisticated technology, algorithms that execute trades faster than the human mind can process, nerves of steel, because in hedge funds, one bad trade can wipe out years of gains. Because in this game, there's only one rule: win. Scene 3. The dark side of hedge funds. Hedge funds don't always win, and when they lose, they don't just hurt themselves. They shake the entire financial system. One of the greatest hedge fund disasters of all time happened in 1998, and it all started with a dream. A hedge fund called Long-Term Capital Management, LTCM, was born from some of the most brilliant financial minds ever assembled. Nobel Prize-winning economists, Wall Street legends, mathematicians who built models so complex that they claimed to have solved market risk itself. They were convinced that their formulas could predict market movements with near certainty. And at first, they were right. LTCM wasn't just winning, it was unstoppable. In 4 years, it turned a $1.3 billion investment into over $100 billion in positions. The fund was averaging 40% annual returns with almost no volatility. The financial world marveled at their strategy. But here's the thing about markets. They don't care how smart you are. The fall of LTCM, the day genius failed. LTCM had built its empire on one dangerous assumption: that markets are rational, that patterns repeat, that spreads between bonds and equities behave in a predictable way. They believed they had mastered risk. But risk cannot be mastered. Then came Russia, 1998. Russia unexpectedly defaulted on its government bonds. The problem? LTCM had massive bets on those bonds, bets that relied on markets behaving rationally. But instead of stabilizing, markets went haywire. The spreads LTCM was betting on exploded. The safe positions they had hedged crumbled. Their models, built on historical data, useless. Within weeks, LTCM was hemorrhaging billions. The collapse was so massive that it threatened the entire global economy. The government had no choice. The Federal Reserve orchestrated a $3.6 billion bailout, forcing Wall Street's biggest banks to step in and save LTCM. The lesson? No strategy is invincible. LTCM wasn't the last hedge fund disaster. But some funds didn't just lose money, they stole it. Take Bernie Madoff, for example. A man once celebrated as a Wall Street icon, a Nasdaq chairman, a financial genius. But in reality, it was all a lie. Madoff didn't invest his clients' money. He simply took new investors' money to pay old investors, creating one of the biggest Ponzi schemes in history. For years, people believed in his too-good-to-be-true returns. Until one day, the lie collapsed. When the 2008 financial crisis hit, investors rushed to withdraw their money. But there was no money left. He had stolen $65 billion. Families ruined. Life savings gone. Charities wiped out. Madoff was sentenced to 150 years in prison, but the damage was irreversible. So what separates a great hedge fund from a disaster waiting to happen? It all comes down to risk management. Because in this game, one wrong bet can end it all. Scene 4. The art of risk management. Hedge funds might seem like a game of high-stakes poker, reckless bets, fortunes won and lost in an instant. But the truth? The best hedge funds don't just chase rewards. They obsess over risk. Because in this world, survival is the real victory. A single decision can mean millions gained or billions lost. But the great ones don't guess. They have a playbook, a battle-tested strategy to navigate even the most volatile markets. This book details 4 essential risk management techniques. The difference between staying in the game and becoming another cautionary tale. 1. Diversification. The art of not putting all your eggs in one basket. Some hedge funds bet it all on one strategy. They ride a wave until it crashes. The smart ones? They spread their bets. They invest across different asset classes, stocks, bonds, commodities, currencies. They use multiple strategies, long-short, arbitrage, global macro, distressed debt. They hedge against market downturns, ensuring they don't sink when tides shift. Because the first rule of investing? Never put all your money in one place. 2. Stop-loss orders. Knowing when to walk away. This is how small losses turn into disasters. Stop-loss orders are preset escape routes, automated triggers that cut losses before they spiral out of control. If a stock drops below 5%, the system automatically sells, no emotions, no second guessing. If a currency trade swings too far, the fund closes the position before a small dip turns into a catastrophe. If a bet on oil goes sideways, they exit before the fire spreads. The difference between winning and losing isn't always making the right bet. It's knowing when to fold. 3. Value at risk, VAR, predicting the nightmare scenarios. How much can we lose if everything goes wrong? That's what value at risk answers. It's not about guessing, it's about math. Hedge funds calculate how much they could lose on any given day, the probability of a catastrophic loss over a month, a year, the exact point where risk outweighs reward. Markets are unpredictable, but great hedge funds prepare for the worst before it happens. 4. Stress testing. Simulating a market apocalypse. What happens if the stock market crashes 40% overnight? Interest rates skyrocket to 10%. A global recession wipes out entire sectors. Stress testing isn't about predicting the future, it's about surviving it. Hedge funds run thousands of worst-case simulations, pushing their strategies to the limit. The lesson? Hope for the best, prepare for the worst. Risk isn't something to fear, it's something to manage. Because hedge funds don't just play the game to win, they play the game to last. Scene 5. The future of hedge funds. So what's next for hedge funds? For decades, hedge funds relied on human intuition, gut feelings, and deep analysis. But now, the future belongs to machines. AI-powered algorithms scan global markets 24/7, detecting patterns no human could ever see. Deep neural networks identify high-probability trades, executing within milliseconds. These systems don't panic. They don't have fear, bias, or exhaustion. They only have data and the ability to predict market movements before they happen. Hedge funds are also embracing the next financial frontier: decentralized finance, DeFi. For decades, hedge funds operated in the shadows of traditional banks, stock exchanges, and central authorities. Now, they're trading crypto assets, making millions from Bitcoin, Ethereum, and beyond. They're investing in tokenized securities, owning fractions of billion-dollar properties on the blockchain. They're using smart contracts, executing trades without intermediaries. No banks, no brokers, just pure, instant transactions. This isn't just finance evolving. This is finance rewriting itself, eliminating middlemen, increasing transparency, and giving hedge funds more power than ever before. The core of a hedge fund will always be the same. No matter how much technology evolves, no matter how fast AI trades or how secure blockchain becomes, the greatest hedge funds still rely on understanding risk. No algorithm can prevent a black swan event. Hedge fund managers still need judgment, experience, and discipline. Adapting to change, markets never stay the same. The best funds reinvent themselves before the competition does. Staying ahead of the curve, the hedge fund industry has always been about one thing: finding the edge before anyone else. Technology changes, strategies change, the game itself changes, but the mindset of the best hedge funds, that never does. So next time you hear about hedge funds, remember, it's not just about big bets and high returns. It's about evolution, strategy, and the never-ending quest for an edge.